deliver a stellar Q4 report card. You're out what the management had to say about the numbers.
As far as JSW Steel is concerned, there is a good volume growth. We have produced 4.31 million tons of production, and we also sold 4.22 million tons. We have reduced our inventory by 1,60,000 tons. So therefore, one is volume contributed to improvement in EBITDA margins because fixed costs are spread over a wider volume. That is one. Number two, on the cost side, we have done a lot of things that also gave us a benefit of reduction in the cost, particularly the conversion cost. Even though there were pressures on iron ore prices, coking coal prices, natural gas price, power cost has gone up, and also electrode cost, ferroalloy cost, there are certain cost pressures. But internationally, the prices went up, and the domestic prices, because of the very robust demand, which was lagging behind the international prices, they caught up in the Q4. So prices also went up, realizations were better. We also changed our mix, product mix we have changed. We also changed our geographical mix. We have moderated our exports to 15% and increased our domestic sales. Domestic sales went up by 41%. Our market share in the domestic market in the Q4 went up to 14.6%. Similarly, our sales to auto industry, which has gone up quite substantially in the last quarter. Our electrical steel, which we sell, it has gone up. Appliances sector has gone up by 67%. So there is special steels which we are selling in the market which have high margins. They went up. Quarterly pricing, which generally we do with auto customers, that impact of higher price has come in the entire quarter. This is also another area where our realizations went up. Long product prices were always depressed in the last year, particularly first half. In the second half, because of the very robust demand for long products, particularly TMT and wire rods, the prices went up substantially. So the benefit of losing money in the long products turned out a good margin in the long products. So better margins in the long products, very good sales of high-end products. The third is change in the geographical mix, change in the product mix, reduction in the conversion cost, and increase in volume. These are the factors which we have contributed for the improvement in the margin in the last quarter.
Also, to take the point forward, you mentioned that there are robust signs of revival in the economy, and this, of course, will translate into higher steel demand. In fact, you said that this quarter also you have seen the growth in demand for steel come in much higher than anticipated. Keeping this in mind, have you made any plans to increase capex, and how do you plan to deploy funds? Also, with so many assets in the stressed asset space, would you be looking at many of these opportunities to expand the scale of production at JSW Steel?
Number one, what is interesting as far as this quarter is concerned, JSW Steel could reduce the debt by 3,500 crores from FY17 to FY18. Our debt has come down to 38,000 crores. Our debt to EBITDA has come to 2.57. Our debt to equity has come down to 1.38. We have been guiding the market that we would like to maintain our debt to EBITDA at 3.75, whereas we were at 2.57. So there is a very big headroom which we have created either for organic growth or inorganic growth. Then taking into account the kind of steel capacity in India and the growth which is happening, there will be a shortage of steel if new capacities are not coming into the country. There are very few companies which are talking about expansion. That is why we thought we should commit more capex, taking into account the current scenario. 130 million ton of installed capacity. In FY18, the production in India was 104 million ton finished steel. So there is hardly any capacity if every year it goes up 7 to 8 million ton. So by 2020-21, there won't be enough capacity in India to meet the growing demand.
Okay.